Oh, so you already opened it?
Yes, yes, I checked. Fantastic.
Okay, that's the reason why you're not here. Okay. Yeah, today we did the revenue part. The nice size. Yeah, yeah.
Welcome back. Let's start another day, another lecture, another topic. So for today, intangible assets, IAS 38, and then lease IFRS 16. You should have done at home or during this morning class, but it doesn't care, the exercises, and then now we can check them together. The first one is from the exam of September. During year one, company A spent 1.45 million in order to carry out a new product. At the beginning of its development, company A estimated that the new product would have increased revenue for 5%. Furthermore, company A completed its development on 31st August year 1 and is ready to launch the product on the market from 1st September year 1. Moreover, testing at the end of the development phase confirmed company A's original estimates on future benefits. Question for this exercise: in accordance with IAS 38, how would you treat the above mentioned scenario? Explain the impact of this business transaction on financial statements at 31st December year 1. And then, if the above mentioned business transaction had not increased the expected revenue, how would you have considered its impact on financial statements at 31st December year 1? As you know, according to IAS 38, in order to recognize an intangible asset, we have to meet all the conditions. And so the first one is the technical possibility to fulfill the intangible asset in a manner that the asset is available for its use or sale. The second one, the capability to use or sell the intangible asset. The next one, the availability of technical and financial resources or whatever other proper resources to end the development of intangible asset and to use it, eventually sell it. Next one, the intention to end the intangible asset for its use or sale. The capability to proper evaluate the attributed cost to the intangible asset during its development or fulfillment. And then the last one, the way in a manner that the intangible asset may generate future economic benefits. Now for this exercise, we have to identify all the conditions in the text. And in order to solve the exercise, you have to do as follows. During year 1, company A spent 1.45 million. 3, 3rd and 5th condition have been met. So, and then if we come back, we can check together these ones. So the first one is the availability of technical and financial resources, because the company owns and spent 1.45 million. And then the next one is the 5th, the capability to proper evaluate the attributed costs in order to carry out the new product, and so on. At the beginning of its development, Company A estimated that the new product would have increased the revenue for 5%. Another condition has been met. The 6th one, this intangible asset will generate future economic benefits, so the increase in revenue for 5%. Furthermore, Company A completed its development on 31st August year 1, first condition. If we come back, the technical possibility to fulfill and so on is available for its use or sale. And let's go. And it is ready to launch the product on the market, second and fourth condition. The capability to use or sell the intangible assets and the intention to end it for its use or again the sale from 1st September year 1. And then the last one, moreover, testing at the end of the development phase confirmed the Company A's original estimates on future benefits. The 6th condition, the way in a manner that and so on will generate future economic benefits. Since all the conditions have been met, the company must recognize the intangible assets in the income statement. Sorry, in the balance sheet. So, and it is the balance sheet at 1st September year 1. Obviously, the amount of research and development costs will be the cost that the company spends during year 1, 1.45 million. And then obviously we do not have the information in the text of the exercise, but amortization starts from the 1st September year 1, when the intangible asset is ready to use. And moreover, we do not have information for what concerns cash flow statement. Any questions? Very easy. Opposite situation. If the above mentioned business transaction had have not increased the expected revenue, how would you have considered its impact on financial statements at 31st December year 1? Yes, Valeria Fazio, you can write intangible, but it's more accurate, so research and development costs. You can call them intangible assets, but it is proper, better, right, research and development costs. Opposite situation. All the conditions have not been met, so we can demonstrate future benefits, and that's the reason why we have to recognize 1.45 million in the income statement. And as you can note, so this business transaction won't be very profitable for the company, because it has to recognize the overall amount equal to 1.45 million in the income statement, which decreases obviously the profit for the period. While if you recognize the research and development costs in the balance sheet, you can spread the cost of 1.45 million over the useful life of the intangible asset. Okay, so for what concerns the second scenario, balance sheet at 1st September year 1, research and development costs are equal to 0, while the income statement will be affected by 1.45 million as research and development expense. Is it clear the difference between capitalization or not of research and development costs?
I have a question. When it's capitalized, is it also recognized in the income statement or only the balance sheet?
Obviously, if you capitalize the amount of the research and development costs, you will recognize them just in the balance sheet, or otherwise, if they are not capitalized, you have to account for them in the income statement. Any other questions? Yes, you can call capitalized development expenditure in balance sheet. This is another way not to call them. Now, this is an exercise for you. This is an excerpt from A2A 2019 Consolidated Financial Statement. That could be useful for your assignment work. So we can read together this part of the notes of the financial statements of A2A. Intangible assets are identifiable non-monetary assets without physical substance, which are controlled by the enterprise and able to produce future economic benefits, and include goodwill when acquired for consideration. Intangible assets are subjected to impairment testing if there are specific indications that they may be impaired, in accordance with the paragraph below. Impairment of assets. Impairment losses may be reversed in subsequent periods if the reasons for which they were recognized no longer apply. And so, intangible assets with an indefinite useful life and those that are not yet available for use and subjected to impairment testing on an annual basis, whether or not there are any specific indication that they may be impaired, in accordance with the paragraph below, impairment of assets. impairment losses recognized for goodwill are not reversed, and gains and losses on disposal of intangible assets are calculated as the difference between disposal proceeds and carrying amount of the asset. And then there is an excerpt, so the following amortization rates for industrial patents, property rights, concessions, licenses, and so on. The questions are: first one, how would you describe the difference in performing the impairment test of intangible assets? Provide a detailed descriptions of gains and losses on disposal of intangible assets. And the last one, what is the meaning of amortization rates applied to intangible assets with a definite life? So this exercise is for you, probably 5 or more minutes in order to solve it. Now I copy the questions in the chat and then we will check them later. This is the excerpt that you have to consider in order to solve the exercise. 5 minutes. You can get the information from these texts, from this excerpt.
You can or you can?
You can.
What did you do? Yeah, we'll check it later. Don't worry. Just sometimes you have to consider useful.
When there is useful life.
I don't know.
Can we check it?
Not yet. Not yet.
Oh, I didn't. I okay, that is. Maybe it's the meaning of confession. I think it's not the thing that useful, right? I will definitely
Okay.
including motive
What the-
as or gene asset, right?
Yes.
So that is the definition of the it's in the question I didn't I think it's not meaning the next one, it's right on top. One type is this.
Let's check it together. First question, how would you describe the difference in performing the impairment test of intangible assets? You should know, according to IAS 38, intangible assets with definite useful life. There are intangible assets with definite useful life, or otherwise intangible assets with indefinite useful life, according to the policy of the company. And then, if you look at the slide, so intangible assets with definite useful life are subjected to impairment test if and only if there are indications that the asset may be impaired, while on the opposite side, intangible assets with indefinite useful life are subjected to impairment test every year without considering indications of losses. Where did you get this information? Intangible assets are subjected to impairment testing if there are specific indications and so on. First answer. The second one is provide a detailed description of gains and losses on the disposal of intangible assets. The procedure is the same as we saw for tangible assets because if the selling price is higher than the net carrying amount, the company gets a gain on disposal. Otherwise, if the selling price is lower than the net carrying amount, there is a loss on disposal. Where did you get this information? From this part. Gains and losses on the disposal of intangible assets are calculated as the difference, and so on. Next one. What is the meaning of amortization rates applied to intangible assets with a definite life? This is another way in order to compute the amortization charge of the year, of the current year. So, for this excerpt, so instead of finding the useful life expressed in years, A2A shows the different rates. It has to be applied to the historical cost in order to identify the amortization charge that will appear in the income statement. Is it clear? No?
Maybe one more explanation.
Okay, so for instance, the historical cost is 100. Useful life is 10 years. The amortization charge will be 100 out of 10 is equal to 10. If you find the rate 10%, if you apply 10% to historical cost, you get again the amortization charge, which is equal to 10. That's the reason why the company can disclose the rates in order to compute the amortization or otherwise the useful life. Is it better now?
Yes.
Okay, let's go on. Another exercise. Company B manufactures machines and has a large innovation program. This is the chart provided in the notes with reference to intangible assets. Development cost net carrying amount at the first January year 1 is equal to 5 million. And then there are additions, namely other investments made by the company during the year, amortization of the year for 1 million, and then impairment loss for 200,000. You have to compute the final amount, namely the net carrying amount at December 31st, year 1. Any idea? Please pay attention, additions, and then amortization, which reduces the net carrying amount, and then the same for impairment loss.
5,800,000.
First answer, 5,800,000. Any other opinion? After the same. Are you sure? Questions of the exercise. First of all, you have to identify the amount disclosed in the balance sheet. And then there is another scenario. Company B presents costs in the income statement according to their function. Do you have enough pieces of information in order to determine the amount of research and development costs to be presented in the income statement? This is the starting point in order to identify the final amount. So please pay attention. In the first column there is the net carrying amount, which is equal to 5 million. But you know, the new additions for the current year are 2 million, which increases the final net carrying amount at the end of the reporting period. And then on the opposite side there is the accumulated amortization or impairment loss for 1,200,000. Impairment loss for new impairment loss for 200,000, and then amortization for 1 million. If you compute 5 million plus 2 million minus the amortization 1 million minus the impairment loss for the year, you should get 5.8 million. Obviously, you have to consider that the additions meet the IAS 38 requirements. Questions? So, let's go on. Drawing up of financial statements. Development costs at the end of the reporting period, namely 5.8 million. And then obviously in the income statement, since the additions meet the IAS 38 requirements, so the research and development expense in the income statement will be 0. But we have to account for 1 million as amortization, and then the impairment loss for the current year for 200,000. Second part of the exercise. Company B presents costs in the income statement according to their function. Do you have enough pieces of information in order to determine the amount of research and development costs to be presented in the income statement? If you look at the slide, this is the solution. So albeit the IFRS 38 conditions have been met for the previous value of such cost, we cannot identify the value of the item research and development costs in the income statement because we don't know the amount of research costs directly expensed in the income statement, since the company classifies cost expenditures according to their function. Is it clear?
So when they classify the item according to the function, it's not possible to understand the
We don't have the information here because the additions meets the requirements of IAS 38, and we don't know the other part of development cost that does not meet the requirements of IAS 38. And that's the reason why you cannot know the final amount in the income statement.
Okay, thank you.
Any other questions? Or otherwise we can go on. Exercise 4 from the first exam of the previous year, October 2020. Consider the following information. Software gross carrying amount as at 1st January year 1, 1.5 million. Accumulated software amortization as at 1st January year 1, 300,000. Accumulated software impairment losses as at 1st January year 1, 100,000. Land at 1st January year 1, 12 million. And then fair value of internally generated brand as at 31st December year 1, 7.3 million. Another useful information is useful life, 10 years. As you can imagine, the question is show impact of these transactions on financial statement at 31st December year 1. This is my advice for you. You have to consider, as we saw during the first lecture, the first tutorial lecture, that's the starting point at the 1st January year 1. This is useful in order to compute the final amount, in order to draw up financial statement. Starting from the gross carrying amount of the software, which is equal to 1.5 million, which is an intangible asset that has to be recognized on the credit side, on the debit side, balance sheet asset side. And then the other T accounts, accumulated software amortization. So these are the previous amortization charges that we computed before, 300,000. Accumulated software impairment losses, 100,000. Again, land is a tangible asset which has to be recognized in the asset side balance sheet for 12,000. And then there is the fair value of this brand. That's an internally generated brand. You should know, according to IAS 38, internally generated brand cannot include, so companies cannot include in their financial statements internally generated brands. That's the reason why this information wasn't useful in order to draw up financial statements at the end of the reporting period. Any question? This information is referred to the 1st January year 1. We have to identify the net carrying amount of these assets at the end of the reporting period, namely 31st December year 1. We know that useful lives are 10 years, And so this is the net carrying amount at 1st January year 1 before computing the amortization charge for the current exercise, namely software gross carrying amount, historical cost 1.5 million, minus the accumulated software amortization at the 1st January year 1, minus the accumulated impairment loss at 1st January year 1, you get the net carrying amount at the 1st January year 1, 1.1 million. Amortization charge for year 1 for the software. As always, you have to consider the historical cost, and the historical cost is composed of the base cost plus the attributable charges that for this exercise were equal to 0. So, historical cost is 1.5 million out of 10 years, the useful life. You get the amortization charge for the first year, for the year 1, which is equal to 150,000. Journal entry, debit side amortization, and in order to follow the equation, accumulated amortization for the same amount. Updated T account. Debit side 150 for software amortization and 150 for accumulated software amortization. Updated situation. Gross carrying amount, historical cost 1.5 million, minus the new accumulated software amortization, which is composed of the previous amortization charges and what you have just computed before, equal to 550,000. Minus the accumulated software impairment losses 100, you get as a final score, as a final value, the net carrying amount at 31st December year 1, which is equal to 950,000. Accumulated amortization on the credit side, probably I did a mistake, just a moment. Yes, you're right, thank you. Okay, now it's better. Thank you, Maria. So the final amount that will appear in the balance sheet asset side for the current software is 950,000. Is it clear?
Being at 1st January year 1, why we still subtract the first 300,000 amortization?
200, the previous amortization charges.
Yeah, we're at 1st January, so if we detract it at 1st
You should consider 1st January minus 1, 1st January is minus 2. It should be better at 1st January year 3. But you can. Yes.
Okay. So in this exercise we subtract now, but usually we don't at 1st January.
You have to consider that 1st January year 1, but it could be you could find 1st January year 0 and 1st January years minus 1. Do you understand this strange way in order to present the information? Don't care about the year 1.
No, in fact I was looking 1st January. So if it is the new value, why we still subtract it if it was the amortization from the last year?
New value. Why?
So we calculate the new amortization, 150,000.
Okay.
And we subtract it.
Yes.
Why are we still counting 300,000 if it was for the last year?
You have to consider also the accumulated depreciation of the previous year.
And shouldn't it be already counted?
You have to count them because the first depreciation charge for the years -1 is equal to 150, plus the second one which is equal to 150, plus the last one 150 that you have just computed.
So 1,000,000.5 was the original.
Historical cost, yes. Gross carrying amount at 1st January. Gross carrying amount is a synonym of gross carrying amount historical cost. It is the same.
Okay.
Is it clear? Any other question? You have to repeat it for the land. Land gross carrying amount. Again, land historical cost at 1st January year 1 is equal to 1. Probably it was 12. Now you know the answer. So the final amount is 12 million. So as you know, land must not be depreciated according to IAS 16 because we have to suppose lands do not lose value over the useful life. This is the only exception according to IAS 36. Land must not be depreciated always. Clear, but probably you already know this aspect. So let's go. This slide shows you how to draw a financial statement the first year. Land historical cost 12 million. Software again. Gross carrying amount or historical cost 1.5 million minus the accumulated depreciation, which is composed of the first depreciation charge equal to 150 plus the second depreciation charge, again 150, plus the last depreciation charge that you have just computed during this current reporting period, 150. You get as a final amount the accumulated depreciation, which is equal to 550,000 minus the accumulated depreciation, which is equal to 100,000, and then you get the final amount of the net carrying amount equal to 950,000. This was for balance sheet, and then let's keep on discussing the income statement. Depreciation is a cost. It is always recognized in the income statement. It is a way in order to spread the cost of tangible or intangible assets over its useful life. Depreciation is equal to 150,000. And then for this exercise, no outflows or inflows for year 1. Any questions so far?
The impairment loss, is it in the income statement?
Impairment loss comes from the previous year. So this is the reason why you have to account it just as accumulated impairment loss and not as impairment loss in the income statement. Did you get it? Any other question? Exercise 5. Lease. Another topic, IFRS 16. On 1st January year 1, the rent company enters into a rental agreement which underline asset in an office building for the company's own use. Value of the building on 1st January year 1 is 8 million assumed fair value. Useful life of the building is 40 years, straight line depreciation, and lease term 12 years. Moreover, for what concerns leasing payments, so advanced payment made on 1st January year 1, 300,000, and then the installments of the contract, 300,000 per year at the end of each reporting period, 31st December. Interest rate 4.5%. Questions, as always, show the impact of this lease contract on rent's financial statement for year 1 until year 12. So, as you know, in order to compute the amount of the lease liability, you have to, first of all, consider the future cash flow that the company will have to pay later, and then by considering the interest rate, you have to compute the present value of the future outflow of cash. This is the way in order to compute the lease liability. And then, if you add, for instance, advance payment, down payment, advance payment, initial direct costs, or dismantling costs, you get the initial amount of the right of use asset. This is the reason why you don't have to consider the fair value of 8 million. It is not useful in order to draw a financial statement, but this is the way in order to compute the present value of the future payment. First of all, 1st January year 1, down payment for 300,000. Since the company signed this contract on the 1st January year 1, you don't have to compute the present value of the down payment, which still remains 300,000. And then let's go. 31st December year 1. Nominal value is equal to 300,000. How do you compute the present value? Nominal value multiplied by 1 plus the interest rate to the power of minus 1, because we are at the 31st December year 1, and you get approximately 287,000. Again, the same computation for the second year. 300,000 multiplied by 1.045 elevated at minus 2, because we are considering the second year. If you do this procedure for all the years, you get all the present values, and then, as you know, the sum of the present values is equal to the liability at the 1st January year 1. Well, 287,000 plus 274,000 and so on, you get approximately 2.7 million, which is the sum of the present values. Lease liability on 1st January year 1, approximately 2.7 million. But you know, in order to identify the right of use asset, you have to compute the amount of the lease liability plus the down payment. And then you get about 3 million. Is it clear? Did you get how to identify the right of use asset and the lease liability on the first January year one? Any questions from home? Double entry record. You have to start from the second one. Right of use asset. Debit side, right of use asset has to be recognized in the balance sheet asset side for 2.7 million. And in order to hold the equation lease liability for the same amount on the credit side. But moreover, you have to consider also the down payment, which increases the value of the right of use asset for 300,000 debit side. And then since the company pays it on the first January year one, you have to account for an outflow of cash for 300,000. Updated the account. Right of use asset, which is composed of the present value of the future outflows of cash plus the down payment. The lease liability on the credit side is equal to 2.7 million, which is equal to the present value of the future outflows of cash. And then there is the outflow for 300,000 since the company paid the down payment when it signed the contract. Now we have to identify, first of all, the reduction of the lease liability, and then obviously the interest expense that the company pays every year at the end of the reporting period when it pays the first installment, and then for the second and the third and so on. First of all, liability at the 31st December year one, obviously before the installment payment, was equal to 2.7 million. If you apply to the liability the interest rate 4.5%, you get financial expenses for the first year. Financial expenses are always recognized in the income statement. 133,000 for the first year as interest expense. But you know, the installment is equal to 300,000. Since the interest expense that you have just computed is equal to 123,000, the difference will be the reduction of the lease liability on the 31st December year one. Because each installment is composed of the principal paid, which is equal to the reduction of the lease liability, and then obviously the interest expense equal to 123,000. Clear? Updated the account. Here, on the debit side of lease liability, there is the reduction after the payment of the first installment, and then the recognition of the interest expense. On the debit side, income statement expense. In order to hold the equation, you have to account for 300,000 as an outflow of cash. Credit side. But the right of use asset is an asset which has to be recognized in the asset side balance sheet, and that's the reason why you have to identify the depreciation, the annual depreciation for the right of use asset. Again, in order to compute the annual depreciation, you have to do 3 million, namely the amount of the right of use asset at the 1st January year 1. We can call it the historical cost of the right of use asset, add up useful life, which is equal to 12 years. You get a depreciation charge of 252,000. Again, journal entry, depreciation debit side, and then accumulated depreciation on the opposite side. Updated the account, depreciation, credit side, and then accumulated depreciation, same amount on the opposite side. As you should know, financial statements according to IAS 1, so the liability side is composed of current and non-current liabilities. And so you have to identify, obviously, the amount of the current and non-current liability at the 31st December year 1. How to do that? First of all, you have to consider the lease liability after the payment of the installment, which is equal to the amount of the liability at the 1st January year 1 minus the first principal paid. 176,000. You get the final amount of the lease liability at the 31st December year 1, which is equal to 2.5 million credit side. But again, you know the installment for the next year is always 300,000. If you apply the interest rate 4.5% to the lease liability at the 31st December year 1 after the payment of the installment, of the first installment, you get the reimbursement of lease liability, which is equal to 184,000, namely the difference between the installment and the interest expense that you have just computed. This is the way in order to get the current lease liability for the next year that you're gonna pay on the 31st December year 2. And then, obviously, if you have just found the amount of the current lease liability, in order to compute the non-current liabilities, you have to do the overall amount of the lease liability for 2.5 million minus the current charge that you're going to pay the next year. 2.5 million minus 184. You get the non-current liability at the 31st December year 1, which is equal to 2.3 million. Questions? This is really important in order to draw up financial statements. Balance sheet, income statement, and cash flow statement for the first year. First of all, non-current assets, right of use asset is equal to historical costs, namely the amount of the right of use asset at 1st January year 1 minus the first depreciation charge as another asset. On the liability side, we have just identified the non-current lease liability, which is equal to approximately 2.3 million, and the charge that you're gonna pay the next year, which is equal to 184,000. If you compute the non-current lease liability and the current lease liability, you get such amount, namely the overall amount of the lease liability, 2.55 million. That's all for balance sheet. And then let's go on income statement. First of all, there is the interest expense that the company paid during the first year for the first installment. And then obviously again the depreciation charge of the right of use asset. And then for what concerns cash flow statements according to IFRS 16, first of all, the amount of 300,000, namely the down payment, you have to recognize it in the investing activity. Moreover, the installment is split in interest paid, operating activity 123,000, and then the remaining part, which is the reduction of the lease liability of the first year, equal to 174,000. Questions? Is it clear? Now it seems to be difficult, but it is not. Let's go on again, second year. You have to repeat what you have just done. So, second year, first of all, you have to compute the financial expenses, which is equal to the interest rate 4.5% multiplied by the liability at the 31st December year 1. Please consider that you have to compute the interest expense at the amount of the liability that is shown in the balance sheet of the previous year. You get the financial expense equal to 115,000 for the second year. But again, the installment is 300,000, credit side. It is an outflow of cash, and then since the interest expense is equal to 115,000, the difference between the interest expense and the cash is equal to the lease liability, namely the reduction of the second year of the lease liability for the second installment. Updated the account. Outflow of cash, installment, 300,000. In order to hold the equation, you have to recognize on the debit side interest expense that will appear in the income statement, and moreover, the reduction of the lease liability for 184,000. Again, as you computed before, the depreciation is equal to the historical cost, namely 3 million. So the amount of the right of use asset that you computed on the 1st January year 1 out of the useful life. and then you get again the same amount. Depreciation, debit side, 252,000. And then accumulated depreciation, credit side, 252,000. If we go ahead, these are the updated T account. Increase of depreciation for 252,000, debit side. And in order to hold the equation, there is the increase of the accumulated depreciation for the same amount. Again, you have to repeat the same process in order to get the non-current and current liability. The starting point for the second year is the amount of the lease liability after the reduction of the first installment and the second installment. You have to consider 2.37 million as lease liability. But again, you know the installment for the next year is equal to 300,000. If you apply the interest rate 4.5% to the lease liability, which is equal to 2.37 million, you get the interest expense, which is equal to 106. And then, so since the reimbursement of the lease liability that will occur the next year is equal to the difference between the installment 300,000 minus the interest expense, you get the current lease liability for the next year. But since you have just identified the amount of the current lease liability, the difference between the whole amount of the lease liability and the current lease liability is equal to the non-current lease liability for 2.18 million. Balance sheet, income statement and cash flow statement for the second year. Again, the right of use asset will be the difference between the right of use asset at the 1st January year 1 minus the first and the second depreciation charge, namely 2.52 million. And moreover, you have just computed the amount of the lease liability, which is composed of non-current and current lease liability, 2.18 million and 193,000. But again, in order to draw up income statement, you have to include interest expense for 115,000 and then depreciation charge for the second year. Since for the second year there's no anymore in the down payment, the investing activity, the outflow of investing activity will be 0. But again, you have to account for the outflow of cash for the interest expense in the operating activity for 115,000, and then the remaining part of the installment is the reduction of the lease liability, which has to be recognized in financing activity. Now there is an exercise for you. You have to identify the amount of the non-current liability and current liabilities for the third and the fourth year. Probably 10 minutes in order to get the amount. I repeat, you have to compute the amount of the non-current liability and current liability for the year 3 and year 4. 10 minutes from now. Obviously, the balance sheet at 31st December year 2 is a starting point in order to get the amount.
How were your answers before? Correct or wrong? To answer.
Yeah, before is correct. Yeah, I understood.
Well done.
Students from home, we are waiting for your answers.
Five minutes left.
There are no answers from home. That could be a problem, huge problem. But let's go on. This is just a recap for you. This is the amortized cost that you are going to study probably during the last week of the course, IFRS 9. But you have to consider just as a recap of the movements of the lease liability. First, January year 1, this is the general amount of the lease liability, the initial amount. Then the interest expense, 4.5% in the income statement. Installment paid, principal reimbursed, and then obviously the leasing liability, the final amount of the leasing liability that will appear in the balance sheet. This amount is split by the current liability and non-current liability. But if you look at the next slide, probably you're not able to see it for the students from the student here. So first of all, balance sheet. This is a recap of the balance sheet, income statement, cash flow statement from the first year until the 12th year. First of all, you should have computed the amount of the lease liability at the 31st December year 3, which is equal to 1.997 million, while the current liability at the 31st December year 3 is approximately 200,000. Did you get the correct result? Yes, Valentina. I hope so. Another answer, Veronica Riello, yes. Do you agree? And then for the fourth year, the amount of the non-current liability is equal to 1.76 million, and then the current liability is equal to 210,000. Any questions? Or otherwise we can skip to the next exercise. When I'll upload the slides, you can see all the balance sheet, income statement, cash flow statement from the first year until the last one. Another exercise on lease. Entity A enters into a leasing contract on 1st January year 1 with the following conditions. Again, cost of assets 38,000. Start date 1st January year 1. Duration of the lease 5 years. Useful life of the underlying asset 6 years. Again, internal interest rate 5.49%. Installment is annual 8,000. But for this exercise, there is the buy option for the C, which is equal, namely the strike price, which is equal to 5,000. But there is another information. Estimated fair value at the time of the option becomes exercisable, 7,000. And moreover, obviously the contract meets the definition of lease under IFRS 16. Again, questions: draw up financial statement for year 1 until year 6. As we saw before saying that, so in order to determine the lease, if you look at the slide, in order to determine the lease liability, you have to take into account also the purchase option, because it is highly certain the lessee will exercise it, because the buy option for the lessee is lower than the estimated fair value. It seems to be comprehensible, so if the company exercises this option, because the cost is lower than the estimated fair value on the market. And then again, starting point, you have to identify the amount of the lease liability and then the right of use asset. The lease liability is equal to the sum of the present values of lease payment. The installment is 8,000. If you compute again the nominal, namely the cash flow multiplied by 1 plus the interest rate elevated at minus t, you get the present value. Second year, again, installment is equal to 8,000. The same for the third year, and so on. But please pay attention, since for the exercise there is the option to buy at the end of the contract the asset. You have to consider it also as a future outflow of cash of 5,000. And then obviously you have to compute again the present value, but please pay attention to 31st December year 5. You have to compute the present value of the 5,000, which is equal to approximately 3.8. And then if you consider just the column of the present value, 7.5 plus 7.1 and so on, you get 37,000. 37,000 is the amount of the rights of use asset, and then obviously the lease liability, because if you look at the text of the exercise, there were not down payment, initial direct costs, or dismantling costs. Do you agree?
What cost of goods?
Cost of goods.
Cost of asset.
You don't have to consider the cost of asset, because it's like we saw before the previous exercise. The fair value probably was 8 million in the previous exercise. You don't have to consider the cost of asset for this time is equal to the present value, but in order to compute always the right of use asset, you have to consider just the present value of the future outflows of cash. For this time, 38,000 and 38,000 cost is an exception. Right of use asset, approximately 38,000. And lease liability, 38,000. So, right of use asset side, credit side, 38,000. In order to hold the equation, again, you have to account for the same amount as lease liability on the 1st January year 1 when the company signed the contract. For what concerns depreciation, for this time, you have to consider 6 years, because the company at the end of the contract is going to become the owner of the asset. And that's the reason you don't have to consider the duration of the lease as we did before, because there is the buy option, which at the end of the exercise, if you look here, it is highly certain that the LC will exercise it. That's the reason why, in order to identify the depreciation charge, you have to consider 6 years. This is important. Otherwise, you get another value of the depreciation. If you look at the box, because it is almost certain to exercise the purchase option. And then again, the right of use asset out of 6 years, you get the annual depreciation charge. Depreciation income statement, debit side, and then in order to hold the equation again, accumulated depreciation for the same amount, credit side. Updated the account, right of use asset, debit side, 38,000, and then lease liability, 38,000 on the opposite side. But moreover, you have to consider depreciation as well for 6,000, and then on the opposite side, accumulated depreciation for the same amount, credit side. And let's go again. In order to draw up financial statement, you have to identify the financial expenses for year 1, which is equal to the interest rate, namely 5.49%, multiplied by the amount of the lease liability at the 31st December year 1. You get the interest expense for the first year, namely 2,000. As we did before, the installment is equal to 8,000. You got the interest expense for 2,000. The difference, about 6,000, is equal to the reduction of the lease liability, namely the payment of the principal. Updated the account. Here there is the outflow of cash. The outflow of cash for 8,000, and then in order to hold the equation, the reduction of the lease liability, and then the recognition as interest expense in the income statement. Next step, again, how to identify non-current and current liability. As we have just done, so first of all, you have to consider the amount of the lease liability after the payment of the first installment, namely 37 minus 5.9, which is equal to 32,000. If you apply the interest expense 5.49% to the lease liability after the first reimbursement of the first installment, you get the interest expense 1.7. But again, in order to identify the current lease liability for the next year, you have to compute the installment minus the interest expense, and then you get the principal paid for the next year. Non-current lease liability will be the difference between the general liability and the current lease liability for the next year. Let's go on. Balance sheet, income statement, and cash flow statement for year 1. As always, non-current asset, right of use asset, which is the difference between the amount of the right of use asset at the 1st January year 1 minus the first depreciation charge. And then let's go on. You have just computed the amount of non-current lease liability and the amount of the current lease liability. When considering income statement, the income statement will be affected by interest expense for 2,000 and then depreciation for 6,000. Cash flow statement for the first year, outflow of cash operating activity interest expense. There is no there's not an outflow of cash for investing activities, since there were not the down payment, the advanced payment for these exercises. exercise, and then the outflow as financing activity, reimbursement of the first principal, which is equal to approximately 6,000. Clear? Again, second year. Depreciation charge, as we did before, is equal to the amount of the right of use asset at 1st January year 1 out of 6 years, because if you look at the box, it's almost certain to exercise the purchase option. And then again, depreciation and accumulated depreciation for the same amount that you just computed before. Updated the account, depreciation, credit side, and accumulated depreciation, depreciation, debit side, and accumulated depreciation, credit side. Let's go on again. For the second year, you have to identify the financial expenses, which is equal to the computation of interest rate applied to the amount of the lease liability at 1st January year 2. And then you get 1.7 financial expenses for the second year. Next one, double entry record, outflow of cash for 8,000, credit side. And then you have to account for the interest expense and then the reduction of the lease liability. Updated the account. Again, here there is the outflow of cash since the company paid the installment, and then in order to hold the equation, there is the reduction of the lease liability for the second charge, and then the recognition of the interest expense there inside income statement. Another term you have to identify non-current and current liability. The starting point is the amount of the lease liability after the payment of the installment at the 31st December year 2, which is equal to 25.84. But you know, again, the installment for the next year is 8,000. If you apply the interest rate to the amount of the lease liability at the 31st December year 2, you get the interest expense. And then, so the difference between the installment for the next year and the interest expense, you get the current lease liability for the next year, for the third year. Again, the difference between the general amount of the lease liability, 25.84, minus the current lease liability for the next year, you get the amount of the non-current lease liability, which is equal to 19.26. Balance sheet, income statement and cash flow statement for the second year. As always, non-current assets, right of use asset, the amount of the right of use asset, which is equal to the difference between what you identified at the 1st January year 1 minus the first and the second depreciation charge. And then liabilities, which is composed of non-current and current liability that you have just identified before. And then interest expense in the income statement and depreciation. The cash flow statement will be affected by an outflow of cash interest expense 1.7, and then the reimbursement of the lease liability for 6.23. Is it clear? Probably it's better than before. Again, this is a recap for you. The amortized cost IFRS 9. First column, lease liability at the 31st December year 1, the initial amount. The next one, interest expense for the year. And let's go on. The next column is the payment of the installment, but please you have to consider also the purchase option. Principal reimbursed, and then you get the final amount of the liability. This is a summary of movements of the liability, the financing liability.
I have a question. How is it when the last payment come? Can you explain the last payment? How is it calculated?
There will be the outflow of cash and then obviously the reduction of the lease liability.
Yeah, but how is the number comes?
30 million.
30, this one,
Yes.
the first installment plus the option in order to get the asset. Did you remember? Installment for the last year, 8,000, and then buy option for the lessee, 5,000.
So we have to sum.
Yes,
Okay.
because it is an outflow that will occur on the 5th year. Here you find an outflows for 13,000 because you have to consider the installment for the last year and then obviously the purchase option, which was 5,000. And then again, this is a recap of the balance sheet from the first until the last year. As you know, you get the final value of the right of use asset after 6 years, because the right of use asset is depreciated according to its useful life, 6 years. But the duration of the contract is just 5 years, and that's the reason why on the column year 5, the amount of the lease liability, current and non-current liability, will be 0. Again, recap of income statement. Depreciation is equal from the first year until the last one, and then the interest expense until the 5th year, because it is related to the 5 years of the contract. Recap of the cash flow statement, just operating activities for the interest, and then financing activity for the payment of the lease liability. No outflows for the 6th year. Last exercise for you. Below you can find an excerpt from Ferragamo 2019 consolidated financial statement. This is from the exam of 2021, April. And then, so the questions are now, I'm going to copy and paste the questions in the chat. Just a moment. Okay, again, 10 minutes in order to answer these questions. What is the amount of the right of use asset as at 1st January 2019 accounted for in the consolidated financial statements? And then, do you have enough pieces of information in order to determine the amount of the lease liability at the 31st December 2019, and why? And how would you describe differences in right of use asset respectively at the end of 2018 at the first day of the reporting period for 2019 and on the last day of 2019. 5 minutes, 5 or 10 minutes in order to get the solution.
Yes, no, because I don't know if you use it because we don't have that much. We need to talk in the refresh present. Everyone is like, because there's kind of new standard started to solve it, I think. So there's a difference between first before we have this new standard. Then after use this new standard. Then something new.
Okay, again, no answers from home. Probably they left the lecture. So, first question. What is the amount of right-to-use asset at 1st January 2019 accounted for in consolidated financial statements? I will forget it. So this is very easy. The amount of the right-to-use asset at 1st January 2019 accounted for in the consolidated financial statement. The second column, 528,000. Next one, do you have enough pieces of information in order to determine the amount of the lease liability at 31st December 2019? Why? No, because first of all, right-of-use asset and lease liability can diverge since the beginning due to the presence of, again, down payment, initial direct costs, and removing and dismantling costs. And then, even in the case of right-of-use asset and lease liability, at the lease commencement date, the right-of-use asset is depreciated, while the lease liability is diminished by the reimbursement of the lease liability. The two amounts are always different. Last slide for today. How would you describe the differences in right-of-use assets respectively at 31st December 2018, 1st January 2019 and 31st December 2019? An International Accounting Standard Board issued these standards during 2019 and it has to be applied since the 1st of January 2019. That's the reason why 31st December 2019 before the implementation of the IFRS 16, 1st January 2019 after the implementation of the standard. And then from the 1st January 2019 until the 31st December 2019 after the first application of the IFRS 16. And then another information additions mean new lease contract signed by the company. Okay, for today that's all. Again, thank you for your attention and see you on Thursday morning.
Thank you.
Goodbye.